Hello, I'm Huntsley of Livewire Markets, and today on The Pitch, our subject is small caps, of both the Australian and global variety. The ASX Small Ords has 192 constituents, but the MSCI World MSCI World Index has more than 4,000 small cap constituents in its index. It's a massive universe, but the person who is going to take us through the differences, the pros and the cons of investing in this universe is Marcus Burns, co-founder and portfolio manager at Spheria Asset Management. Marcus, welcome.
Hans, thank you.
So I think it's no secret that small caps have struggled in the last 2 years, but over the long term, they are one of the better performing asset classes. What do you think that comes down to?
Just to be clear, we're talking about globally or domestically, Hans?
Globally. Yeah.
Globally, okay, yeah. So globally, they are one of the best performing asset classes. If you look over a very long run, like something like 30 odd years, they've outperformed large caps by about 1% per annum. So you've had pretty close to 9% compound over, say, a 30-year period, whereas large caps are giving you around about 8. Obviously, there's more volatility in that, but I think the reason they tend to outperform over the long run globally is they're less mature, so it's easy to grow. You know, the law of small numbers, you can grow off a smaller base faster than you can off a large base. So there's that kind of natural growth rate accelerating over time. And they typically have more dynamic and entrepreneurial founders, who are often running these companies. So they drive them harder, I think, than some of the more bureaucratic large names.
So when you look at the current state of global small caps, what do you find are some of your key observations when you compare global peers to the ASX smalls?
Yeah, look, it's a good question, and we get asked that quite a lot. Why would you look globally versus domestically? And I think the answer really is, as you said in your introduction, the universe is so much bigger. There's 4,000 stocks, so it's 20 times the size of Australia. As a result, you get so much more opportunity to invest in interesting companies, interesting names. We tend to be a little bit overcrowded here as well. So high quality names here get bid up to the moon in Australia. Globally, there's much more outlets for those high quality names. There's more people looking at them, and so the valuations are much more appealing globally. So we can find excellent quality names internationally that are in many cases, a fraction of the multiple of Australia, with the same kind of, forecast growth rates looking forward.
Sure, absolutely. So if I think about the macro environment we are in or we're about to enter to, we're seeing a lot of our global peers start cutting interest rates, but we're still 6, 9, 12 months away, however long that may be. Do you think global small caps are more appealing even just in this moment, given that cutting cycle has started overseas? Well, not necessarily.
That's a $1 million question. Really is. I think. I think there's a short term and there's a long term angle here. I think if you said what's the best long term opportunity set, I would definitely say international, because it's just such a big universe. And in the immediate term, yes, you've had rates being cut in the UK, in Europe, Canada, Switzerland, New Zealand even. US is yet to cut rates, and obviously Australia yet to cut rates as well. So, but you have to remember that 2/3 of that index globally, or 60% of the index globally, is actually in the US. So they haven't cut rates yet, although prospectively we're probably a month and a half, 2 months away from the theoretical cut there. So I guess that does put a bit of a rocket into small caps. So yeah, I think probably in the short term you might get a bit of a kick from those rate cuts globally. But I'll also say long term, I think the opportunity set is so big that if you have a good process and discipline, I think the opportunities internationally are probably better than Australia.
So I want to pick up finally on what you were saying earlier about sometimes, because we have such a concentrated market of quality small and micro cap stocks, that they get bid up to the moon. And when I think of bid up to the moon, I think of overcrowding. So where are you seeing overcrowding in that space? And come to think of it, can be avoided if you're willing to look offshore.
Yeah, okay. So first part of the question, I think, yes, we are seeing overcrowding in Australia. By the way, we see that quite often in small caps in Australia, not just overcrowding, but bubbles forming where there's momentum around, say, AI type stocks right now, or technology stocks that perform really well over this period. So even though rates are rising, it's been the growth names and those associated with AI that have been bid up aggressively. So names like NextDC in the small cap land, WiseTech, Pro Medicus. Often these are great businesses, but they're well and truly discovered here. Internationally, the escape valve of that massive market opportunity set means that the stocks aren't as highly valued. And so yes, we would argue that definitely long term there's good opportunities internationally, and because there's overcrowding of certain names in Australia, correspondingly there's also areas that get left behind. So we're seeing opportunities in areas like the property sector, for example, more cyclical areas like media, some of the retail names that have been left behind by this rally that we think are really interesting currently.
Okay, so that's examples of overcrowding in Australia. Is there examples of, say equivalent stocks offshore that are trading less expensive or on more attractive valuations that, you might point people to instead of, I guess congregating in those Pro Medicus's and WiseTechs and the very few.
Yeah, like absolutely, and I guess one example of a stock we own in our fund globally is called Sapiens. It's a software stock that sells software to the insurance market, so it does sort of a lot of ERP and marketing software for insurance companies. And it's got a double-digit growth rate, and it's trading on a multiple that's probably a quarter of what say WiseTech would be trading on. So good balance sheet, great return on capital, good margins, all the things Australian investors love, and yet the valuation is probably sitting at around P of around about 22, 23 times versus WiseTech on say over 100. So yes, there are many examples like that internationally that we find through our screens that I think people could find internationally if they're willing to put the work in.
Perfect. Marcus Burns of Spheria, thank you very much for joining us. And thank you for joining us for The Pitch. If you enjoyed that interview, you can subscribe to the Livewire Markets website, as well as our YouTube channel, where you can find more episodes of The Pitch. Join us again soon. Take care.